Okay, welcome, ladies and gentlemen, to another edition of MACROACE. This is your host, Tony. Thank you very much for joining me live. I'm also the head financial analyst at FinancialJuice. So, CPI, we've got about 30 minutes, so let's get into the prep. Now, what is it? It represents how much consumers are paying for retail goods and services. And the way it's measured is you have 26,000 retail outlets, 4,000 housing units in 87 urban areas, where prices are collected on 80,000 goods. 8,000 goods and services. So the key measurement then of how it's made up, you have housing, which represents about 42%, food and beverages 14%, transportation 18%, and medical care about 8.5%. And then you have the core CPI data, which excludes food and energy, which is the most volatile part of the report for the headline inflation figures. Then you have the seasonally adjusted, which is the more preferred measure when looking at changes to inflation. The reason why it's preferred is because it shows what's going on within the economy without the effects of weather and production cycles and so on. Yes, hello to everyone in the chat. Hopefully you're all doing good. Hopefully you're ready. And I'll try and get you as ready as I can with the prep for CPI. All right, so the difference between PCE and CPI price index, key thing is PCE places a lower weighting on gasoline and residential rents, and focuses on the nation as a whole rather than just focusing on the urban areas, which the CPI does. So how does it affect the market? Usually you tend to see a stronger dollar if the inflation print is much stronger than expected. And of course, the expectation is a stronger CPI will lead to the Fed maybe holding on to their rates for longer than what the markets may be pricing in already. And then on the flip side, for stocks, stronger data can lead to a bearish reaction because of course, if you keep interest rates high for longer, then that means that the tightening then continues to go on for longer and borrowing rates remain high. And then, of course, that affects equities and the amount of profit that a business can make. And for the bond market, bond yields, if you do see a stronger than expected report, they can also rise as well. Similarly to the dollar, for the same reasons, if the Fed is looking for evidence of disinflation continuing at the pace that they want, but it doesn't happen, and you do get a bump, and if it's a very strong bump back towards the upside, then that means there's going to be a lot of repricing of how long the Federal Reserve is going to hold on to the rates where they are at the moment, and in turn leads to higher yields as well. Bond prices, of course, will have the inverse reaction because as yields go higher, bond prices go lower. Now, the other reason why bond yields can go higher in a different environment when the economy is growing or coming out of a recession, or the Federal Reserve is looking for a growth within the economy, higher than expected inflation reads could show that the economy is in a healthy position or becoming healthier as prices start to rise again. All right, so the previous report in January. So with the core month-to-month data, the index, it said that the indexes which increased in December included shelter, motor vehicle insurance, and medical care. And the index for household furnishings and operations, and the index for personal care were among those that decreased over the month. Now, this is also another thing that we need to be aware of. Is going to be more of an after. It's going to be something you'd have to look at afterwards in the report itself. Is how much disinflation, or is there any disinflation in the services side of the inflation report? The good side of the inflation report has been coming down quite nicely, but it's a services side that's still a bit tricky and hard to bring down. So you'd have to, as I said, look at it. You'd have to look at it after the report to see if the Federal Reserve, when you're pricing in what the Fed might do, besides the data itself, is that if services inflation is still persistent, will that be enough for the Fed to then hold back or wait a bit longer and be more patient for it to eventually decline and then see true disinflation going towards the Fed's 2% goal. So where is the economy at the moment? What do we need to understand about what can affect in the inflation report? So we had non-farm payrolls, which was stronger than expected at 350k compared to the prior, which was revised to 333k. Unemployment rate remained unchanged. Average earnings increased 4.5%. Employment costs decreased 0.9%. PC price index year on year was unchanged at 2.6%. Core PC price index year on year was at 2.9%, so a slight a decline there. Manufacturing prices paid increased to 52.9. Services prices increased to 64. Then productivity had declined a bit to 3.2%. Import prices had increased to 0%. Export prices remained unchanged. The PPI, which is also going to be coming out this week as well. PPI increased to 1% from the prior 0.9, and the core PPI year on year had saw a slight decrease to 1.8% compared to 2%. Don't forget, if you found these live streams useful in the past before, if this is your first time jumping on and you enjoy it and you find it useful, then don't forget to share it with your fellow traders and friends. Give the video a like, subscribe to the channel, get the word out there, and join the gravy boat. Now, the other important thing that we need to have a look at is the adjusted data for CPI that came out. Now, off of the back of this data, the revisions that were made by the BLS show that inflation was slightly weaker than what they had seen, than what was reported before. And what this led to is a bearish reaction on the dollar. This came out at the same time as, or around the same time as the Canadian employment change data. So when I was looking at it, the Canadian data was good, but then these headlines came out, and that led to a drop off in the CAD dollar because, of course, it's dollar denominated. When the dollar had declined, the overall strength in the Canadian dollar had also declined alongside the dollar as well. So although it didn't surprise to the upside, meaning that the Fed is still on path towards their target and they're doing well, it's still important to note that it had a negative reaction on the dollar when inflation was lower in the revisions. The triggers then for the economic release. So the month-to-month of what economists are looking at, a high estimate of 0.3% with a low of 0%, year-on-year with a high estimate of 3.3% and a low of 2.8%. Core month-to-month with a high estimate of 0.4% and a low of 0.1%. And then finally, the year-on-year core with a high estimate of 3.8% and a low of 3.6%. So sentiment and views, I'll try and get through this quite quickly, or as quick as I can. We've got quite a bit here. So Bank of America, they're first up on the board. They said that upside risks to inflation could be among the most disruptive for the markets and may drive the Fed to be particularly cautious as we approach the start of the easing cycle. And today, in their update of what they had provided, they said that a report in line with our expectations will continue to build the Fed's confidence and support our expectation for the first cut to be in June. Now, this will be the first of the 5 reports till then, and that could mean that the January report might not shift their expectations for monetary policy that much. So if they're to summarize, if the inflation report has a reaction, there are still going to be 4 other reports until the June meetings when they expect the first Fed rate cut to occur. Doesn't mean that you can't put it out of the water and say, all right, forget about it. Of course, that's looking at the inflation data and how the Fed might react over a longer term period. The short term reaction that we've got to be focused on is how much of a deviation is there, and do we get any And then in the future, do we get any comments from Fed members being surprised by the data, or maybe considering changing their position on easing policy, which probably won't happen, considering how in the past Fed members have said that there might be a few bumps here and there. But as long as inflation is headed towards the 2% goal, and there is a good amount of disinflation that is occurring rather than being very stale and sticky, then not much is really going to change in terms of pricing. Goldman Sachs, they said that they pushed back their forecast for the first Fed cut to May from March, given Powell's comments at the January press conference, and their expectation is of solid growth in Q1 and a temporary firming in sequential inflation in January. JP Morgan, they say that the read-throughs are that US consumer may continue to support the economy in an at trend or above trend manner over the next 1 or 2 quarters at least. And then the imminent fear is that another inflation peak, according to one that Alice, is that they would be less concerned about another inflation peak unless they see an exogenous shock via commodity prices. So PPI report, of course, that's going to be important to have a look at it when that comes out, the commodity prices part for the report. Barclays then join in. They say that with the Fed on a more patient stance at present, it will take a large downside miss for March rate cut to come back into play in earnest. So it's still on the table as a potential scenario. If inflation is much weaker than expected, that is something that could happen according to Barclays. And for us, when you're looking at trading it, if it is much weaker than expected, across the board, all of the figures are lower than the forecast, then that could mean you could get more volatility that's within the markets, meaning that there are more opportunities that could then be presented to you rather than having to deal with a whipsaw and then crazy short-term or very quick moves where the markets are confused as to what the Fed's goal is going to be and what their path might be. So in line with expectation data, a market is confused usually, and they'll try and take a direction depending on what they feel, and then you kind of have to sit back and watch. But if you have a clear indication of data being much stronger than expected or much weaker than expected, then you get more opportunity and more clarity when you trade it. Does that make sense for everybody? I know some people are asking CPI negative or positive, 2.9 long risk on. You just got to wait for the data. You just got to see, as well, I kind of just said that if data is as expected, then it's difficult to pick a direction, and then you're just leaving it to the market to help you. But okay, I see people say super clear. Nicholas says super clear. Valentin says yes. Okay, perfect. So let's move on then. So Fed and government views. Fed's Logan said that I don't see any urgency to adjust rates, and we need to build confidence on inflation. Guru Chef, what can I help explain? I'm here. We've still got about 15 minutes or so to the release, so we've got a little bit of time. Basically, any economic release whenever you're trading it, you've just got to focus on what the figures are, how big is the deviation, and then make your choice. So it's kind of hard. If you can predict what the figures are going to be, then I'll give you all my money and you can take it and run with it. Matt P says, what's more important, core month on month or year on year? At this point, it's all of the figures that are important, because any one figure could disrupt what the expectation is for the Fed. Either way, whether it's higher or lower. So you've got to look at all of the prints together rather than just one figure. I have said earlier on that the seasonally adjusted month-on-month figure is the one that has the most precedence over the other figures, because it provides a seasonal adjustment and removes any of the factors such as weather or production cycles, or usually when times and when there's a lot of spending, let's say in the Christmas period, it might adjust for those certain seasonal adjustments. But that's that's when market conditions are normal and the central bank isn't doing anything with the monetary policy. It's all the same. When the central bank is going back to their normal phase and their normal settings, wherever they want to, whenever they reach their neutral rate, and then they're fine and dandy. Yeah, so you've kind of got to be careful with all the figures, because if one of the figures is weaker or stronger than expected, but the rest of the figures go in one direction, it could potentially moderate the impact of the release. So that means a market reaction could also be moderated too, to a certain degree. But let's kind of go through the rest of this and let's carry on. I'll get back to the questions in a bit. Fed's Barkin said that upcoming inflation data is likely to be favorable. Inflation has surprised to the upside before. Collins, who's a non-voter, but said that the Fed doesn't need to go all the way back to 2% inflation to ease. On the 31st of Jan, Powell at the press conference at the last rate decision said that if inflation moves back up, that would be a surprise at this point. Remember, Powell is representing all of the Fed members' views as one view. So if there is a bit of a surprise towards the upside, then that could definitely lead to a big repricing of what to expect for the rate decision, particularly if it's higher than the previous figure, is what, of course, the Fed will also be looking at too. Then there's some real cause for concern if it's stuck around 3.4% for the year-on-year, or if we're looking at some of the other figures for the month-on-month, if it's at 0.4%, if there's been a bigger change in inflation in the last month of January. And then the Fed rate statement said that the Fed does not expect it will be appropriate to reduce rates until there's greater confidence that inflation is moving sustainably towards a 2% goal. Off the back of that, you had the dollar that strengthened and the S&P 500 that had weakened. So the markets were looking for a commentary or a confirmation that a March rate cut could happen or would happen, and the statement just blew it out of the water and said, not yet, son. Then if we're looking at the market pricing then, so Fed swaps post the Fed statement, they remain steady, pricing around 140 basis points of easing in 2024. The first Fed rate cut in March versus May was then priced in at even odds based on rate futures. And then later on, it was pushed out to May instead for the first rate cut. And even then, when we had the employment data, then that was more or less kind of nudged out towards June instead. Okay, so if we look at the past market reaction then and see how the markets had reacted. Ooh. Let's kind of skip back. Well, I mean, you can kind of see it there now. So this is about 5 seconds before that release, back on January the 11th. And we'll just have a little watch of it and see how, and you can see how the markets had reacted, that there was that initial little whipsaw that had occurred. You can see that with one of the bits of data, with the core month-on-month, it was in line with expectation. So that's something to just be careful of if all the data doesn't come if all the data doesn't go in one direction or the other, you could get this sort of reaction where there might, because of the sensitivity of how the markets are and the fear of if inflation does tick higher, that the central bank may hold off on cutting rates. That's something just to be aware of and be careful of. So the ideal scenario is for data to go in all in one direction, one way or the other. Okay, so if we keep going forward a little bit, and I've made a little trade there, and let's keep going. Okay, let's go back to see if I can find later on in the video. Yeah, so the market reaction, you can see even after about 10 minutes or so, that the market reaction held at about where it but it did peak, and there wasn't a further decline or rise for any of the assets. It kind of just then went sideways instead. So we keep going, and that was with a 0.1% deviation on the core year-on-year and 0.2% deviation on the year-on-year. If we keep going a bit more, yeah, so okay. So some initial moves towards the downside were quite decent, and then after about 10 minutes, and they were just kind of after a bit of a pullback. Even after that stronger than expected data, you then had the markets reversing a little bit and then going sideways. So if we look at the ranges and deviations, just to have give a bit more insight as to what happened afterwards. Okay, so this is the beauty of the ranges and deviations. It shows you how strong the market reactions have been to economic releases. So we're looking at the CPI data here. We've got a bunch of other releases too, not just CPI, non-farm, Canadian employment change, PPI data, rate decisions. But we can see here, so this is the interesting thing. So one bit of data, okay, was the outlier, which was as expected. But the initial market reaction was the strongest since September 13th of 2023, based off of the sensitivity of where we are at the based off where we are at the easing at the cycle at the moment with the Federal Reserve. We are now at the precipice of the Fed could cut very soon, so pricing becomes even more sensitive, and speculation does too, for the Fed might do. Hence, you get bigger reactions when the markets become more speculative. So this time round, you had an initial movement. So this first figure shows you the initial movement going to the wick of the candle, okay, which you had seen 77 ticks down in the S&P. There was a bit of a pullback after 10 minutes, okay, going to the end of the candle in the black brackets here to 63 ticks, but was still down. And after about 30 minutes of trading, then it continued to go down, and it went down, and then it was down by 91 ticks. So if we do get a flush, if everything is goes all in one direction, and that there are no figures that are in line with expectation, particularly if there are no figures that are in line with expectation, because you can see here in the past where you more or less have had figures that are in line with expectation, and then the market reaction is quite choppy. You can see here, a perfect example in August, 66 ticks towards the upside. After 10 minutes of trading, it was down by 24, and after about 30 minutes, and then it was up by 39 ticks. Hence, I say, you're looking for the data to go all in one direction to provide you with a stronger, more volatile market reaction. Ideally, if we get a 0.2% deviation in all of the figures, then that would potentially provide a very strong reaction within the markets. But even if there's a 0.1% deviation on all of the figures, either way, that doesn't mean that that's not going to provide a decent market reaction, as we'd seen here in the past bit before. Okay, just something to be aware of. So if we're looking at the currency pairs, then we can see that the dollar yen has always seen, majority of the time, has always seen the strongest market reaction compared to the other currency pairs. And if we're looking at the bond areas, it's been the 2-year bond because that's the most sensitive to rates, to interest rates, and what's going on within the economy. Of course, the 10 years used as a barometer overall between the short-term and long-term rates and how the economy is doing. But the 2-year here is the most sensitive. Hence, it gets the largest reaction within the bond market. Okay. So, hopefully that makes it clear for everyone. Now, the way you can get your hands on this here is with a ranges and deviations sheet. This is live and in real time that I update this, okay? And you can have a look at it, use it however you want to use it. But if you want to get your hands on it, all you got to do is subscribe to the MACROACE mailing list. Yes, we have 4 minutes left. Thank you very much. Dancing Bear. Weird name, but hey. Great. If you want to subscribe to the MACROACE mailing list, you get a link to, so the Monday morning I'll be sending out an email for you to have which will then provide you a link to the ranges and deviations sheet. Whoops. There we go. Didn't know why I didn't want to do that. Yeah, it will provide you with a link to the ranges and deviations sheet. And just to give you an example of what else that includes, so here you can see this is basically the email. It gives you, you see here that the links for the ranges and deviations, links to the live streams that we'll be doing for that week, if there are any, and then a short-term review of what to expect in the Asia, Europe, and US session of things to look out for. Okay, and a summary of the weekend news if there is anything. That's the email. Okay, just so you guys understand what it is supposed to be. So it's short and snappy. It should act as a refresher. There isn't a lot of detail because I go through the detail here with you guys in the live stream for the economic releases. So yeah, if you wanted to get your hands on that, then you can subscribe to that mailing list. And then every Monday, once a week, I provide an update for the week ahead of what to expect. Okay, so let's get on that. All right, we've got about 2 minutes, so I'm going to get to my trading setup. And then we'll have a little look. Get here. Okay. Dollar yen, S&P. Got gold here. Got the 2-year bonds, futures. Let's get TICKSTRIKE up and running. Okay, there we go. All there, all fine. Okay, why do you all said what if it appears equal? What could be the reaction? So as I said earlier, if you do get data that is in line with expectation, then it's more likely going to be a mixed reaction. I.e., there's going to be a lot of whips roaring because the market's trying to understand what the Fed is going to do. So we've got a minute. I'm going to go quiet at the 10-second mark, but remember, month-to-month high estimate is 0.3%, low estimate 0%, year-on-year with a high estimate of 3.3% and a low estimate of 2.8%, core with a high estimate of 0.4 and a low of 0.1 for the month-to-month, and the year core with a high estimate of 3.8% and a low of 3.6. Yeah, fair enough. I would not blame you if you want to stay away from CPI. All right, let's see how it goes. So as I said, I'm going to go quiet now. Okay, so I made 2 trades there. One was off of the, well, of course, the initial spike. Then wait for a little bit of a pullback, and then went short again on the NQ. So now it's down to a tick strike to kind of see how strong the selling momentum is. Of course, well, still strong at the moment, but we'll kind of think with the 2 trades that are done there. The NQ is not having a good day. Let's look at some other areas too. Let me just move that out of the way. Actually, let me do a quick check of the initial market reaction on here. Okay, that is much stronger than it was in the past. So let's go again. And this will be my final one. So I'll be done and dusted once this is done. Okay, all right, that's it. That's me done. All right, cool, nice. So 3 good trades, and yeah, so there's a much stronger than reaction than before what we'd seen in the past. So 504 ticks towards the downside on the on the reads. Excuse me, on the NQ. The read stronger than expected. 3.1% for the year on year. Month on month was at 0.3%. Core remained unchanged compared to the prior, but it was also 0.2% higher than the previous forecast compared to the forecast of 3.7%. Core month on month was also higher, 0.4%. So a nice set of figures is what you wanted. And they gave us the, there we go, traders of short-term US interest rate futures bet that the Fed will not cut rates until June after the strong inflation data. What else we've got? Fed swaps assign lower odds of May and June rate cuts, and they price in less than 100 basis points of easing in 2024. Okay, ouch. Ouchie, ouch. Did you not see the other, the 2 trades I just made? The first one, I of course didn't have. Whoops, I didn't have on the screen. The other 2 trades though, you should have seen that happen. And of course the last one that I just did on the screen. Oh. Jeff Marty says they can't raise rates or the government defaults. I mean, I don't think they're going to raise rates. Yeah, well, I mean, it is a bump. It is still lower than the previous figure for the CPI year on year, albeit higher than what the markets were expecting. The core, still remaining sticky. Actually, let's do this. Let's have a look at the, because I want to have a look at the report too of whether services inflation is still stronger or not, or if it's, I mean, without looking at the report, it looks like it is, but I just want to see how much of a difference that there was. So let's bring this up. Okay. Sorry, I'm just gonna get TickStrike out of the way. Also, as I said, with using TickStrike, what it does, it allows you to listen into order flow. Or another way to view it is how strong is the buying or selling momentum within the markets of stocks, futures, forex, crypto, ETFs and ETNs, and your internals, you can have a look at how strong the buying or selling momentum is of those different assets. And that's what TickStrike allows you to do here. And that's what I used here for when I did those 2 trades or 3 trades for the inflation data. But so let's have a look through the report, see what we had. Quite interesting. And I'm kind of covering it. I don't want to. There we go. If I just did it. Yeah. Okay. You guys should be able to still see everything. Food ticked up. Ooh, okay. Services less energy by 0.3% compared for the month. 5.4%. Yeah, that's not okay. Transportation. That was not a good point there. So hopefully you can see that there. That's definitely not something that the Fed would want to see. Hence, you're not seeing. Well, you're not really seeing a reversal as of yet. Really, no. You're still seeing that downward pressure. When I mean reversal, as in it's bouncing off of its bottom and then continue to go higher. But here, it so far, it's trying to, but it doesn't want to. Well, we'll see. We'll see how it plays out. But yeah, so transportation, if we're looking at the month-on-month comparison, big old jump by 0.9%. Medical care jumping by 0.2%. Used cars and vehicles, nice decline. What else? Yeah, so it just looks to be the transportation services. It is services, okay? It's just services is where you're getting the main meat of this increase from. Oof. Okay, they're pushing. Said that on the wires. If you're listening into the live voice and text, now they're pushing it out for a rate cut expectation to July, is what the markets. There you go. Fed swaps shift full pricing of rate cut to July from June. Can it get to August? Remember, there are, of course, 4 other reports that have come out. Well, now let's say now 5. Yeah, including now June, including this report here. So if the next series of inflation reports, and the majority of them, don't show, if they show something similar to this, then the Fed has, of course, it's very obvious, has an issue on its hands. And it makes it more difficult for them to then consider whether or not to cut rates. Maybe, I know somebody said in the comments that that they wouldn't, because it could lead to the economy defaulting. However, saying that, the economy so far, regards to jobs, consumer spending, is and GDP is still quite strong at the moment where we are in the current situation with the US economy. But again, it all depends on the rest of the data that comes through. Does data then weaken over time and give the Fed a bit of reprieve, a bit of breathing room to then be able to say that they can cut rates? Or if data is still strong and the inflation is choppy, then they could lead to maybe further rate cuts. Potentially. This is just one report until we get some more confirmation of what is said, and also what the next Fed rate statement is going to be like. And now that next Fed rate decision, we'll get these summary of economic projections too. So their thoughts on where they think interest rates and PC inflation is going to be. So yeah, how did everyone else do? Did we all do good? Hopefully everyone did well. Does anyone have any other thoughts on the inflation print? T.S. Long said fine, good. But yeah, Matt P waiting for a break lower here in the ultra. Okay, first time you trade CPI and it was excellent. Wow, if it's your first time trading CPI, I mean, it's a nice easy example considering how the data went. So yeah, well done, Gladys. Michael T says thanks for the effort. Thank you for joining me live, and thank you too, Bart. Don't forget, if you like the video, subscribe to the channel, get the word out there, and share the knowledge. Share what I'm sharing with you to everyone else. Okay, so that's a report there. Let's close that out. As said, now we're using FinancialJuice for a live voice and text service. So if you're a day trader, then all you got to do is, if you're a day trader, then having a live voice and text service is a very key tool for you to use within your day trading. The reason being is because we keep you up with what's going on within the markets, such as the market pricing for Fed rate decisions, or even the ECB now as well. Here, money markets pricing 110 base points of ECB rate cuts in 2024 compared to 120. Not a lot, but still keeping up to date with what's going on. That's I'm tempted. So look at what the euro is doing. I'm going to do Euro GBP because I know I can get a different idea. Something different. Okay. Okay, there we go. Okay, I am back. So as I was saying, having a live voice and text service. Well, I've kind of explained it now, but if you want to have access to if you want to have access to FinancialJuice, then we have also got a special offer that we have at the moment, New Year 92. So you can get FJ for 1 year for the price of a monthly subscription of $99 rather than a grand. Okay. With this promo code that we have, New Year 92, and I'll also provide you the link to the place where you can have a look at it. Okay, that's the code there. And this is the pricing too. First, before you make a decision whether or not you subscribe to FinancialJuice, what you need to do is make sure that you have an account on FinancialJuice. So that will set you up with the light version of FJ, which has a delay. There are adverts that are played that are on there, and as I said, there's a delay across the site. But if you wanted to create a pro subscription, create an account with your login details, verify your account through your email, and then when you're ready, then in the top left hand corner here, you can see that there's a little slidey bar, which you should be able to see there. Next to that is a logo, which will say Go Pro. Select that, and that will take you to which subscription that you want. Once you've paid and it's all set up, then log out and log back in, and then you should see the pro version of FinancialJuice. Okay, so just kind of clarify over the details then. So you have the live voice bit, which is controlled here. You should be able to see that. There you go. The text headlines are in the middle here in the center with an update of how the markets had reacted. Okay. Left-hand side is your economic calendar as well of all the upcoming economic releases. Tomorrow we have UK CPI. So if you want to wake up nice and early for that in the morning, then that's also can also be a very good trade and has been in the past. Who needs Netflix? The finance world is the creamy. Creamy. Thanks for the stream. Thank you, Ari. But yeah, so on the left hand side, as I said, you have the economic calendar as well. Okay, and in the center here, you have the need to know market risk, keeping you up to date with what has occurred that's caused the markets to move, or if there's a headline that could lead to a market reaction or such. Okay. So I said that's a link there for you to have a look at the pricing. As said, New Year 92, you get 92% off the yearly subscription of FinancialJuice for the price of now 1 month. So you get it for $99. Okay, so there's also if you're not ready to do that, and that's perfectly fine. Get used to how FinancialJuice works. The stream, how it can be incorporated into your trading, your day trading. Once you're comfortable, even though there may be a delay, of course, whilst you're using the light version, it gives you an idea. Get comfortable, and then when you're ready, then you can choose whichever subscription that you want, if you're ready, if you want to. Same thing with TICKSTRIKE. So the live version of TICKSTRIKE here, as you can see, so if we're looking at the dollar yen, so this ticker box here represents the buying and selling momentum of the dollar yen here. Okay, the ticker box, and you have different numbers that represent that. So this, let me just make this a bit bigger so it's a bit easier. So we're currently looking at the dollar yen ticker and the dollar yen chart. This slider here and the numbers you can see represents the sensitivity of that ticker. So if you set the sensitivity on 1, that's the most sensitive to market reactions. So when there's a little bit of buying or selling that occurs, then TICKSTRIKE will give you a visual and audio alert. So you can see there in real time. Okay, you can see that there's the buying momentum as the dollar yen seeing some upside move there too. Now, you can drag this slider, okay, all the way up to 15. 15 is the least sensitive to market reactions. So only when there's a big amount of buying or selling momentum for that time, then TickStrike will give you a visual and audio alert. And you can choose whether to go visual or audio, up to you. And the colors, of course, you can change to whatever you want to change it to. Now, one other final thing to kind of show you with TickStrike is we have a lightning bolt symbol. What is a lightning bolt symbol? Well, come have a look. Lightning bolt symbol is uber sensitive to market reactions. So every little bit of buying or selling momentum, selling that's going on within the dollar yen, and of course any of the other assets you want to look at, then it will display that there, here with the lightning bolt symbol. So remember, 1 is the most sensitive to market reactions. The lightning bolt goes 15 levels below 1, so it's uber sensitive to market reactions, as you can kind of see here. So it's more or less mirroring what's going on with a little bits of jumps here and there within the dollar yen. So again, if you like scalping the markets, if that's for something for you, then you can use that tool there. And there's a link to TickStrike, which is right here. Okay. Yeah, let me pin the area, the message where you can get access to the MACROACE mailing list, okay, to get your hands on the ranges and deviations sheet. All right, so that's TickStrike there, and you can kind of chop and change to do whatever you want to do with it, whatever level of sensitivity is fine for you. Okay, so just going to put that back, and then there we go. So that's TickStrike there. That is the stream for this week. Now remember, I'll go over it again with the email, just to clarify. So what will happen is with the email is you'll get it on a Monday with a link to the ranges and deviations, okay, as such. Okay, like this here. You get a link to the ranges and deviations, and you'll get a link to the upcoming live streams if there are any, a short summary of what to expect in the different sessions, Asia, Europe, and the US, and a summary of the weekend news if there has been anything of noteworthy news. But yeah, so it's supposed to act as a refresher for you guys there. All right. Thank you very much for joining me live. I'm just going to see if anyone has any questions or any comments. But yeah, like I said, don't forget to hit that like button. Just like T.S. Long said, hit that like button. Subscribe to the channel. Get the word out there. So the first trade, it was as soon as I could on, as soon as the spike hit, and I placed the trade and went short. And then the second trade, you'd seen it, waited for a bit of a pullback, and then jumped in again on the on a short on the NQ, and then the third one, well, you've seen it. Okay. All right. Ladies and gents, thank you very much. Have a great day. Have a great weekend. And I shall see you next time.